Obviously, I look at it the last few days and I wonder if I'm right, but the last few days feels like a pause in what is going to be a steady rise in interest rates. And I don't think this is a cataclysmic rise in interest rates. If the 10-year gets to 2 or a little bit above that, that's not going to kill the economy. It's not going to kill the markets. But what it is going to do is knock down higher priced, hyper growth stocks. So I think that this respite we've had, particularly in technology for the last couple of days, is not over. As far as sitting on my hands, yeah, that's true. I haven't done anything in the last few days. I did raise some cash in the last couple of weeks. You know that. I certainly haven't deployed it because I don't think we're anywhere near the end of the volatility that I see coming, because the Fed has basically changed its support of the stock market. And there's nothing wrong with that, all right? This isn't head for the hills time. It means just have a little dry powder for volatility that should come. I'm still 90% invested, so I'm not thinking that there's a bear market or some disaster afoot.
I just wonder if this is yet another head fake on rates. Josh, we're moving lower. We're 172. We've moved a lot, obviously, in the last 8-9 days, 30 basis points or so. But we've declined from there. By the way, UBS today says they expect the 10-year to move to around 2% in the coming months. And in terms of where we are in the market, you don't think that the correction or the pullback or whatever you want to characterize it as is over. You said on the closing bell yesterday, right now this bounce does not look like the bounce. There's a lot more puking that needs to take place in a lot of areas of this market. What specific areas still look a little bloated to you, Josh?
So to be clear, I'm referring specifically to the NASDAQ. I don't think the selling's over. There was a little bit of a kick save 2 days ago. There was an intraday violation on the NASDAQ itself below the 200-day moving average, and some buying came in, and we got a really nice 2-day rally, which seems to have already stalled out. And if you think about how a lot of the components, forget the Qs, the NASDAQ composite, how many stocks we're talking about, what's going to end up happening is a lot of these names are going to make a lower high as this bounce peters out. So you don't want to see lower highs. And unfortunately, that's what it looks like we're set up for. And what that ends up doing, so I'm just talking about charts, but now let's talk about what that does to sentiment. As people who have been crushed in NASDAQ stocks, and remember, 40% of the NASDAQ is already in a 50% drawdown from last February, as people start to see that pattern of, oh, great, my stock's rebounded, but why didn't they rebound to the price that I bought it? You end up seeing real capitulation, and selling begets more selling. So that process has to play itself out. I don't think it's a disaster, depending on how you're allocated. It's certainly not a disaster in the FANG names. They look fine. They don't look great, but they look okay. ARC is in a 45% drawdown as of this morning. Obviously, that's a much different story. So, and there's a very broad spectrum between those two things. Like, there's a lot of distance between Apple and Teladoc, let's say, right? But if you think about the newer investors who have come into the market over the last year and a half, 2 years, what stocks do they own? They own DraftKings. Like, you know where they are. And so from that standpoint, I don't think sentiment is bad enough to say this is the bottom. I really don't think there's been enough damage. I think there are still market caps that are 20 billion that are on their way to 10 billion. And we have to just sit through that, unfortunately. We have to watch that play out. And that's what's happening right now.
You know, Pete, that view is shared by the likes of Paul Tudor Jones, I think. When he was on Squawk Box earlier in the week, he talked about historical multiples of the NASDAQ, kind of where it is now relative to where the unemployment rate is now, relative to where interest rates could be going from here, and the reset that would still need to happen, sentiment that was really shared by Brad Gerstner with me the other day as well, who thought you could still have a 10 to 15% compression in multiples going forward, specifically on the NASDAQ, and a lot of those higher valuation, higher price to sales stocks, which have certainly gotten hammered, but maybe not hammered enough. Is that still the most acute part of the worrisome area of the market? I can't hear Pete. We'll work on Pete's audio. Carrie, you want to entertain that same question? Because I'm sure you have thoughts on it as well.
Yeah, sure. It's interesting, Scott, that tech had really underperformed the market in the first couple of quarters of 2021, ended up pretty close to financials in terms of being up, around 30%. So despite this decline in the NASDAQ, and as Josh pointed out, there are hundreds of names on the NASDAQ, tech companies that are down, 30 to 80%. And I ran a screen of the names over 3 billion market cap. There are 160 biotech and tech names, more than 30% off their 12-month high. So the market and technology as a sector has continued to go higher despite these companies going lower, and they can coexist.